Markets rise and fall in cycles that shape every investor's journey. Yet most people misunderstand how these swings work. Bull markets inspire confidence and greed, while bear markets create fear and doubt. Understanding the dynamics behind these cycles is crucial for long-term success. In this video, you will learn what drives bull and bear markets, how to navigate them, and why awareness separates consistent winners from reactive investors. Like and subscribe to gain insights that make market cycles work for you. 1. What is a bull market? A bull market is a period in which prices of assets rise steadily over time, reflecting investor confidence, economic growth, and strong corporate performance. It is often characterized by optimism, high liquidity, and increased risk appetite. While the term may sound simple, the underlying forces are complex. Investor sentiment, interest rates, inflation, corporate earnings, and global economic conditions all interact to create upward momentum. 2. What is a bear market? A bear market is the opposite, a period in which asset prices decline significantly, often by 20% or more from recent highs. It is typically fueled by negative sentiment, economic contraction, high interest rates, or uncertainty. Bear markets trigger fear, causing investors to sell, which amplifies the decline. While frightening, these periods are essential for the long-term health of financial markets. They prevent overvaluation, create buying opportunities for disciplined investors, and reward those who maintain perspective. 3. Investor psychology in bull and bear markets. Human behavior drives much of market movement. During bull markets, optimism can become irrational exuberance, leading to overconfidence and risk-taking that exceeds rational capacity. Conversely, bear markets often trigger fear and loss aversion, prompting hasty selling and missed opportunities. Recognizing these psychological tendencies is crucial. Investors who are aware of emotional patterns can act rationally, avoid herd mentality, and capitalize on market cycles. 4. Economic drivers behind market cycles. Markets do not move randomly. Bull and bear periods are often influenced by fundamental economic factors. Growth in GDP, corporate profits, technological innovation, and low interest rates typically support bull markets. Conversely, recessions, rising debt, geopolitical uncertainty, and policy tightening contribute to bear markets. Investors who track these drivers gain insight into potential shifts in market conditions. 5. Volatility as a natural companion. Bull and bear markets are accompanied by volatility, the daily and weekly fluctuations in price that often feel chaotic. Volatility is not risk itself, but a measure of uncertainty. During bull markets, volatility may create short-term dips, which are healthy for sustainable growth. During bear markets, volatility spikes, testing investor patience and discipline. Investors who understand volatility as a natural companion to cycles remain calmer, avoid impulsive decisions. 6. Timing versus positioning. Many investors obsess over timing the market, attempting to enter at the lowest point of a bear or exit at the peak of a bull. This approach is notoriously difficult and often counterproductive. A better strategy is positioning, maintaining an asset allocation and risk strategy that can weather both bull and bear conditions. Proper positioning ensures participation in upside growth while protecting against downside loss. 7. Opportunities in bear markets. Bear markets, while intimidating, create unique opportunities for long-term investors. Price declines allow assets to be purchased below intrinsic value, offering higher potential returns when the cycle recovers. Disciplined investors who have prepared with cash reserves or flexible allocation can take advantage of these periods. Historically, some of the greatest wealth accumulation occurs when others are fearful. 8. Lessons from bull markets. Bull markets teach a different set of lessons. They reward risk-taking, innovation, and patience. However, they also expose the dangers of overconfidence and speculation. Investors must maintain discipline, avoid chasing trends, and rebalance regularly. Overexposure during bull runs can create vulnerability when the market shifts. Learning to enjoy growth without abandoning caution is a subtle but critical skill. Bull markets are a test of strategy as much as bear markets, and consistent winners navigate both with equal discipline. 9. Long-term perspective over short-term noise. Markets are cyclical by nature, but individuals often focus on short-term fluctuations. Successful investors maintain a long-term perspective, understanding that bull and bear periods are temporary phases in a much larger cycle. Wealth is created not by reacting to each movement, but by staying disciplined, diversified, and aligned with personal goals. Historical data confirms that staying invested over decades consistently outperforms attempts to avoid short-term downturns. Perspective transforms emotional stress into measured action and reinforces the value of patience. 10. Building a portfolio for market cycles. The ultimate lesson from bull and bear markets is the importance of designing a portfolio that endures both conditions. Diversification, asset allocation, rebalancing, and defensive positioning allow investors to participate in growth while protecting capital during downturns. Systems, not emotion, dictate results. By preparing for cycles, investors transform uncertainty into predictable outcomes. Building a portfolio with resilience and flexibility ensures that both the ups and downs of the market serve long-term wealth accumulation rather than causing panic or regret. Understanding cycles empowers strategic action and long-term success. Bull and bear markets are not random. They are natural cycles driven by psychology, economics, and systemic forces. Success comes from understanding these dynamics, positioning portfolios wisely, and staying disciplined during both growth and decline. Long-term wealth depends on systems and strategy, not reaction. Like and subscribe to continue learning how to navigate market cycles, protect capital, and build consistent wealth over time.